How payments and money movement actually work in the UK. When people think about payments, they usually think about what they see: tapping a card, sending money through a banking app, or getting paid at the end of the month. What they rarely see is the infrastructure underneath that makes those actions possible. In the UK, money does not move as a single system. It moves through a set of specialised payment schemes, settlement systems, clearing mechanisms, banks, intermediaries, and regulators. These systems operate continuously, at national scale, and with very little tolerance for failure. This video explains how payments and money movement actually work in the UK, not from a consumer finance perspective, but from an infrastructure and operational perspective. How money moves between accounts, which systems are involved, who operates them, and why the system behaves the way it does. What a payment really is. At its core, a payment is a change in balances. Money does not move as physical objects between banks. Instead, records are updated. One account is debited, another is credited, and settlement ensures that institutions remain in balance with each other. The complexity arises because payments happen between many independent organizations that must trust each other's records. That trust is provided by infrastructure. The role of banks in payments. In the UK, most money movement happens between accounts held at banks or building societies. Each bank maintains its own internal ledger recording customer balances. When a customer sends money to another customer at the same bank, the transaction can be handled internally. When money moves between banks, an external payment system is required to coordinate the change in balances between institutions. The three core UK payment schemes. The UK operates three primary domestic payment schemes. The first is BACS. BACS is used for bulk, low-value payments such as salaries, pensions, and benefits. It operates on a batch processing model. Files are submitted in advance, processed overnight, and settled on a fixed schedule. When an employer pays salaries, the instruction is sent days before employees see the money. This predictability makes BACS suitable for large volumes and payroll processing. The second is faster payments. Faster payments supports near real-time transfers between UK bank accounts. Most personal transfers and many business payments use this system. Although it feels instant, faster payments still involves interbank messaging, risk checks, and settlement processes. Banks place limits on transaction sizes and monitor activity continuously. Third is CHAPS. CHAPS is used for high-value payments, often involving property transactions, corporate transfers, or financial markets. These payments are same-day and individually processed. CHAPS is operated with direct oversight from the Bank of England because of its systemic importance. Who operates these systems? The operational responsibility for BACS and faster payments sits with Pay.UK, an industry body that manages the schemes on behalf of the banking sector. CHAPS is operated by the Bank of England itself. This separation reflects risk. Systems that could destabilize the financial system if they fail are operated or overseen more directly by the central bank. Settlement and the Bank of England. Settlement is the process that ensures banks actually owe each other the correct amounts. Most settlement in the UK happens through accounts that banks hold at the Bank of England. These are known as settlement accounts. At the end of a settlement cycle, banks with net outgoing payments must transfer funds to banks with net incoming payments. This is done by adjusting balances at the central bank. This mechanism ensures that payments are final and irrevocable once settled. Why settlement timing matters. Different payment schemes settle on different schedules. BACS settles on a delayed, predictable cycle. Faster payment settles multiple times per day. CHAPS settles continuously during operating hours. These differences affect liquidity management. Banks must ensure they have sufficient funds available to settle their obligations. Liquidity management is a core function of banking infrastructure. Card payments are different. Card payments operate through a separate infrastructure. When a customer pays by debit or credit card, the transaction goes through a card network such as Visa or MasterCard. The merchant's bank, the card network, and the issuing bank all play roles. Authorization happens first. The issuing bank checks whether the transaction should be approved. Settlement happens later, often days after the transaction. Card payments involve interchange fees, scheme fees, and acquirer fees. The infrastructure is international, but UK regulation shapes how it operates domestically. Why card payments feel instant but are not. From the customer's perspective, a card payment looks instant. From an infrastructure perspective, it is a promise to settle later. This separation between authorization and settlement introduces risk. Chargebacks, fraud, and disputes are handled through established processes defined by card schemes. These processes add complexity but enable widespread acceptance. Cash still matters. Although digital payments dominate, cash remains part of UK payment infrastructure. Cash distribution involves the Bank of England, commercial banks, cash centres, and ATM networks. Physical cash logistics are managed separately from digital payments but remain important for resilience and inclusion. The UK maintains cash infrastructure even as usage declines because access to cash is considered a public interest issue. Faster payments in practice. A faster payments transaction involves multiple steps. A customer initiates a payment through their bank. The bank performs fraud checks, balance checks, and compliance checks. The payment message is sent through the faster payments infrastructure to the receiving bank. The receiving bank credits the recipient's account often before settlement occurs. Settlement between banks follows later. This requires trust between institutions, supported by limits, monitoring, and regulatory oversight. Fraud and risk controls. Payments infrastructure exists largely because of fraud risk. Banks monitor transactions for unusual patterns. Limits are imposed on payment sizes. Delays may be introduced for suspicious activity. Fraud prevention systems operate in real time, analyzing behavior across millions of transactions. These controls influence how fast and flexible payment systems can be. International payments. International payments add another layer of complexity. Traditional international transfers use correspondent banking relationships. Messages are sent through systems such as SWIFT. Settlement happens across multiple intermediaries. This introduces delays, fees, and opacity. Newer systems attempt to reduce friction, but international payments remain more complex than domestic ones. Open banking and AP is. Open banking introduced a new way to initiate payments. Under UK regulation, banks provide APs that allow authorised third parties to initiate payments directly from customer accounts. These payments still use existing infrastructure, often faster payments, but initiation happens through a different channel. Open banking does not replace payment schemes, it changes who can trigger them. Payments in government services. Government is a major user of payment infrastructure. HMRC collects taxes through multiple payment channels. Benefits are paid through BACS. Grants and refunds use faster payments. Government payment volumes influence infrastructure capacity and operational priorities. Reliability is critical. Failures affect millions of people. Payments in businesses. Businesses interact with payment infrastructure differently from consumers. Payroll systems rely on BACS. Suppliers may be paid via faster payments or CHAPS. High-value transactions use controlled processes. Businesses integrate payment infrastructure into accounting, reconciliation, and reporting systems. Clearing versus settlement. Clearing is the process of calculating who owes what. Settlement is the process of actually transferring funds. In some systems, clearing and settlement are separate. In others, they are tightly coupled. Understanding this distinction explains why some payments are reversible and others are not. Why payments fail? Payments fail for many reasons: insufficient funds, incorrect details, fraud controls, system outages, or cut-off times can all prevent a payment from completing. Failures are handled differently depending on the scheme. Infrastructure is designed to fail safely rather than silently. Regulation and oversight. Payment systems are regulated heavily. The Payment Systems Regulator oversees competition and access. The Bank of England oversees systemic stability. The Financial Conduct Authority regulates firms participating in payments. These bodies influence how systems evolve. Why change is slow? Payment infrastructure changes slowly because mistakes are costly. A flaw in a payment system can cause widespread disruption, financial loss, and loss of trust. As a result, New features are introduced cautiously, tested extensively, and rolled out gradually. Future pressures. UK payment infrastructure faces ongoing pressures: rising fraud, demand for instant payments, international interoperability, and digital currency debates all influence direction. However, core principles remain the same. Reliability, finality, and trust matter more than novelty. Closing perspective. Payments and money movement in the UK are not apps or features, they are national infrastructure. They operate quietly, continuously, and at enormous scale. They are shaped by law, risk, and operational reality. Understanding how payments actually work explains why sending money is sometimes instant, sometimes delayed, and sometimes blocked. In the next video, we will look at how fraud detection, monitoring, and financial crime prevention operate as infrastructure across these payment systems.